Don't scroll. Give me 10 seconds. Open your banking app right now. Look at your balance. Now imagine waking up tomorrow, and that number is still there, but you can't withdraw a single dollar. ATMs shut down. Banks temporarily closed. Prices doubling overnight. And nobody warned you. This isn't a movie. This is how financial systems collapse. Stay with me, because by the end of this video, you'll understand exactly how money loses its meaning, and why most people only realize it when it's too late. What if one morning you woke up, checked your phone, opened your banking app, and your balance was still there, but it meant absolutely nothing? No error message, no warning, no dramatic announcement, just a number that couldn't buy you bread. This is the story of the day money lost its meaning. And it didn't start with fire in the streets. It started with silence. At first, it looked like a normal Tuesday. Markets opened. Coffee shops filled. People complained about traffic. Influencers posted motivation reels about multiple income streams. Financial experts went live promising stability. But behind the screens, something was cracking. For years, the system had been stretched beyond logic. Governments printing more currency than ever before. Central banks lowering interest rates to zero. Corporations borrowing billions to buy back their own stock. Investors chasing profits in assets they didn't understand. Debt wasn't a warning sign anymore. It was the fuel. Every crisis had been fixed the same way. Inject liquidity. Create more money. Kick the consequences into the future. And the future finally arrived. It began in the bond market, the most boring, least viral part of finance. The place no influencer talked about. But the bond market is the foundation. It's where governments borrow. It's where trust lives. When trust cracks there, everything above it shakes. Interest rates started rising faster than expected. Governments needed more money to cover their old debts. Investors demanded higher returns. Banks holding long-term bonds suddenly faced massive unrealized losses. At first, they called it temporary volatility. Then one major bank announced it needed emergency liquidity. Not bankruptcy, not collapse, just liquidity support. But the market heard something else. Fear. Within hours, stock prices of financial institutions dropped 20, 30, 40%. Social media exploded. Hashtags trended. Financial YouTubers went live with red thumbnails screaming, this 2008 again." People rushed to withdraw cash. Not because they fully understood what was happening, but because they remembered what happened before. Banks operate on confidence. They don't actually hold everyone's money in a vault. They lend it out, invest it, multiply it. So when too many people ask for it back at once, the math breaks. ATMs started running out of cash in certain cities. Banks limited withdrawals temporarily. Governments reassured the public, your deposits are safe. But something felt different this time. Because the problem wasn't just one bank. It was the currency itself. Inflation had been climbing for years. First slowly, then stubbornly, then aggressively. Groceries doubled. Rents surged. Energy bills exploded. Officials said it was transitory. It wasn't. When prices rise faster than wages, money begins to lose purchasing power. And when people realize their savings are shrinking not because they spent it, but because the system diluted it, trust erodes. Now combine inflation, rising interest rates, over-leveraged banks, and massive sovereign debt. That's not a spark. That's dry forest waiting for lightning. And lightning struck when a major foreign government announced it would begin trading commodities in a different currency. Oil, the backbone of global trade. For decades, oil had been priced in one dominant currency. That currency's power wasn't just economic, it was psychological. But when alternatives appeared, cracks widened. Foreign central banks began reducing their reserves, selling bonds, diversifying assets, which meant less demand for that currency, which meant it weakened, which meant imports became more expensive.
Which meant inflation accelerated. And suddenly, money didn't feel like security. It felt like melting ice. People began converting savings into anything tangible. Gold. Real estate. Cryptocurrency. Even canned food. Grocery stores noticed panic buying. Not dramatic looting. Just quiet hoarding. Because the scariest collapses don't begin with chaos. They begin with realization. Realization that numbers on a screen are promises. And promises require trust. The stock market didn't crash all at once. It bled. Retirement funds lost 10%. Then 25%. Then 40%. Pensions became unstable. Companies that relied on cheap borrowing couldn't refinance debt at higher rates. Layoffs started. Unemployment rose. Government tax revenue fell. So what do governments do when revenue falls and expenses rise? They borrow more. But lenders were demanding higher interest. So central banks stepped in again.
Printing, injecting, stabilizing. But this time, the medicine worsened the disease. More money chasing fewer goods. Hyperinflation doesn't announce itself politely. It accelerates exponentially. At first, prices rise monthly, then weekly, then daily. Workers demanded higher wages just to survive. Businesses increased prices to cover wage increases. A feedback loop formed. Savings accounts became irrelevant. People rushed to spend paychecks immediately before prices climbed again. Restaurants removed printed menus because prices changed too often. Landlords demanded rent in foreign currency or assets. Digital payment systems experienced outages, partly technical, partly overwhelmed. And then came the announcement that changed everything. Banks would close for a short financial reset. 3 days. That's what they said. 3 days to stabilize markets. But when banks reopened, withdrawal limits were permanent. International transfers were restricted. Capital controls imposed. In that moment, the illusion shattered. Money had lost its meaning. Not because numbers disappeared, but because access disappeared. You had funds. You just couldn't use them freely. That's when people truly understood money is not paper. It's not digits. It's freedom. And freedom had been throttled. Black markets formed instantly. People trading goods directly. Services for food. Electronics for fuel. Bartering returned. Not because society regressed, but because trust shifted. Cryptocurrency usage surged. Not as speculation, but as survival. Local communities created informal exchange networks. Meanwhile, global markets spiraled. Foreign investors pulled out completely. The currency devalued further. Import shortages worsened. Pharmaceutical supplies thinned. Energy rationing began. And politicians blamed each other. Some blamed foreign adversaries. Some blamed corporations. Some blamed greed. But the truth was deeper. The system had been built on exponential debt in a world with finite production. You can print currency. You cannot print trust. And once trust is gone, rebuilding it is harder than building skyscrapers. The middle class suffered the most. The wealthy had diversified into assets long ago. The poor had little to lose. But the middle, the savers, the salary earners, the retirement planners, watched decades of discipline dissolve. Panic turned into anger. Protests erupted. Not violent at first, just desperate. People demanding answers. Where did our money go? But money didn't go anywhere. It was diluted, devalued, redefined. Governments attempted a digital currency rollout, promising stability, transparency, modernization. But citizens were skeptical. After all, if the previous system collapsed under control, why trust a more centralized version? International alliances shifted. Trade agreements renegotiated. A new monetary order slowly formed. But transitions are painful. Years of instability followed. Businesses closed permanently. Entrepreneurs struggled to price products in a fluctuating currency. Education systems cut funding. Healthcare strained. Crime rose, not out of evil, but desperation. And yet, humanity adapted. Because collapse is not the end. It's transformation. Communities grew tighter. Local production increased. People learned skills again, repairing instead of replacing. Financial literacy surged because ignorance was no longer affordable. Children grew up understanding inflation, debt cycles, and monetary policy, topics once reserved for economists. Eventually, a new equilibrium emerged. A restructured currency backed by tangible assets and stricter fiscal discipline. Not perfect, but cautious. The collapse became a case study taught globally. The day money lost its meaning wasn't remembered as chaos. It was remembered as awakening. An awakening to a simple truth. Money is a social agreement, and agreements require responsibility. Unchecked greed, infinite leverage, and political short-termism can erode even the strongest systems. But awareness can rebuild them. The real tragedy wasn't the collapse. It was the years of warnings ignored. Economists had cautioned about unsustainable debt levels. Analysts highlighted asset bubbles. Citizens complained about cost of living, but optimism bias and political convenience drowned caution, until reality forced attention. If there's one lesson from this story, it's this. Stability is invisible when it exists. You don't appreciate functional banks, stable currency, predictable prices until they vanish. The collapse wasn't caused in one day. It was built over decades, through small compromises, temporary fixes, emergency measures that became permanent, and the day money lost its meaning was simply the day consequences caught up. So what protects a system? Transparency, balanced budgets, productive investment instead of speculative bubbles, and citizens who understand that economics isn't abstract, it shapes daily life. In the aftermath, new leaders emerged, not charismatic populists, but disciplined reformers. Policies prioritized sustainability over speed. Debt ceilings enforced. Central banks regained independence. Regulations tightened around leverage. Growth slowed, but stabilized. It took a decade to restore full confidence. A generation carried scars. But that generation also carried wisdom. They questioned narratives. They diversified savings. They valued real productivity over hype. And most importantly, they never again assumed money was permanent. Because money is a tool, a powerful one, but fragile. Remove trust, and it becomes paper. Remove discipline, and it becomes inflation. Remove access, and it becomes illusion. The day money lost its meaning wasn't the end of wealth. It was the end of blind faith. And sometimes, losing meaning is the first step toward rediscovering value. If you're listening to this story comfortably, with stable prices, working banks, functioning markets, understand something powerful. Stability is earned, and it can be lost, but it can also be protected. The collapse taught humanity that financial systems are not invincible machines. They are mirrors, reflecting our behavior, our discipline, our greed, our patience. When behavior becomes reckless, the mirror cracks. And when it cracks, everyone sees the reflection. The day money lost its meaning changed the world. Not because currency disappeared, but because illusions did. And when illusions fall, reality demands responsibility. The question is not whether another collapse is possible. The question is whether we will recognize the warning signs before history repeats itself. Because systems don't fail overnight. They decay quietly, until one day, everyone wakes up, and the numbers on the screen mean nothing. And that was the day money lost its meaning.